I'm Sarah Borgson-Keto, and in conjunction with NAREIT's REIT Week 2020 Virtual Investor Conference, I'm joined today by video link with Anne McCulloch, President and CEO of Housing Partnership Equity Trust. And thank you for joining me today.
Happy to be here with you.
What role does affordable housing play in restarting a strong and sustainable post-pandemic recovery?
Well, housing is critical to our individual and our community safety and well-being and our ability to rebuild the economy. Today, your home is your place to shelter from infection. It is your home school, it's your elder care facility, and if you're fortunate, it's your telework office. And as we reopen the economy, people who have safe, affordable housing will be in a better position to rejoin a revitalized economy.
What are among the key priorities facing affordable housing communities at this time?
Well, we're going to go through three phases of response to the crisis. First, survive. Second, stabilize. And third, thrive. And surviving means that the first priority for affordable housing providers is to protect the health and well-being of residents and frontline staff. Our team quickly transitioned to remote working while our partners on the ground enhanced property management. Stabilize means we'll also have to support our residents through this crisis. That means that property managers are working with residents who need rent flexibility, and as well as helping residents apply for benefits where they're eligible. As the health crisis has unfolded, it's become really apparent that the impact's going to be longer and deeper than many of us initially thought, particularly in the working communities that we serve. So I expect the stabilized phase will be bumpier than you might hope. There'll be more ups and downs for a while. And thrive means we have to look longer term and recognize that this crisis may change jobs outlooks. So some industries will see increased demand, particularly in critical functions like healthcare and transportation and delivery services, where a number of our residents already work, where others may not come back at the same scale or quickly, such as retail and restaurants, which is also sectors that our residents serve, which means we may need to help our residents add new skills so they can rejoin the new workforce that we have, which means we may need to partner with community colleges who are really the leading experts in delivering career and technical education to people who are looking to retool where they are in the market. And at the same time, I think the crisis has really revealed the extent of the digital divide, so that our communities are in suburban locations and in cities. They have residents that you expect have full internet access in their homes, but it turns out that many have been relying on their cell phones and using the office's computer facilities when they actually needed serious computer time. And that isn't sufficient for telemedicine appointments, for homeschooling, for the time it takes to apply for benefits, and for working remotely. So going forward, we're going to have to close the last part of the digital divide and make sure the good internet access is standard for all residents.
Do you anticipate any changes in terms of how you go about attracting investor capital into social impact investing?
Sure. Interest in social impact investing has been growing dramatically in recent years, and I think that growth is going to accelerate with this crisis. First, the crisis has demonstrated the value of investing in things that are essential, not optional, and nothing is more essential than housing. As a result, I think we'll be able to attract visionary impact investors who have seen in stark relief the importance of housing and want to seize this opportunity to change the housing landscape going forward and strengthen our communities. The crisis is going to create new opportunities to acquire and preserve housing, frankly, at better prices than we've seen in recent years. Why? Because the next year is going to be rocky in real estate. So folks who don't have deep expertise in the asset classes they've invested in, or who don't have the capital or commitment that's going to be needed, are likely to exit, creating opportunities for the rest of us. Impact investors are like all investors. They expect to make a fair risk-adjusted return, which means it's important to invest with partners with deep expertise in real estate who've been through good cycles and bad, and who have strong knowledge and roots in local markets, because the recovery is going to differ from market to market. Similarly, while returns may suffer over the next year, the ability to buy assets at better prices than we've seen in a long time means we'll be able to generate better returns over the long term while also preserving affordability. That's why I think our model of having a national team that has deep expertise in commercial real estate and strong on-the-ground local partners who know their markets and sub-markets and are available to access opportunities will be particularly competitive and particularly attractive to impact investors as we go through the crisis.
And thanks again for joining me today.
Thank you. Appreciate it.
And for more news and analysis on REITs and listed real estate, be sure to visit NAREIT's website, REIT.com.